Hello and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, February 10th, and I'm recording this from my office in Purchase, New York. Headlines these days continue to be dominated by concerns about tariffs and capital spending by the megacap tech companies. Against this backdrop, the S&P 500 index has mostly been range-bound. It is up 2.5% year-to-date, while the bond market has experienced increased volatility. On the surface, many investors might conclude that this is just a seasonal dynamic that doesn't really change the bull market thesis. However, looking at the data and considering current market dynamics, we see that the shift that we have been signaling about market broadening and leadership rotation is increasingly being confirmed. First, let's consider the fundamentals, where the lagged impacts of monetary policy are now beginning to shine through. While many investors have bemoaned the fact that the Fed has only delivered 100 basis points of easing before this most recent pause, we're seeing evidence of a renewed cyclical impulse. In fact, ISM manufacturing indices, for example, which have long been in contractionary territory, returned to expansion in January, driven by a surge in new orders. Manufacturing hiring also appeared to pick up, while the Fed's survey of loan officers suggests a solid increase in bank lending availability. We should note, however, this is not a strong or broad reflationary thrust. Rather, it seems somewhat idiosyncratic, as indicated by one of the lowest intra-market stockwise correlations in decades. The second factor hinting at a changed leadership regime are earning dynamics themselves. So far, fourth quarter earnings have been mixed, considering that revisions were negative coming into the reporting season. Easy comparisons and reduced forecasts suggest that the S&P 500 will end 2024 with profits of around $240 a share, up 8.5% year over year. Meanwhile, the composition of surprises is shifting, with the largest 100 stocks in the index surprising at a much lower rate than the next 400. Moreover, with continued anxiety around CapEx spending by the Magnificent Seven, earnings growth for the group is poised to continue to decelerate, converging with the accelerating pace of the other 493. In aggregate, 2025 earnings forecasts are now at about $274 per share, down from 6 months ago when estimates were closer to $282 a share. And here's a final and perhaps most compelling indicator of the rotation, the movement of the market itself and the technicals around them. Consider that in January, the tech sector underperformed the benchmark by its widest margin since 2016, and prices of 4 of the Mag 7 stocks have broken below their 50-day moving averages. Hedge funds are increasingly reducing their net exposures, while company insiders are selling at the highest rate since 2021, raising questions about earnings achievability and valuations. Lastly, just look at what is leading the market: financials, healthcare, mid-cap growth, European stocks, and gold. So overall, while our soft landing thesis continues to hold, these developments provide confirmation that market leadership is in fact changing. Investors should consider adding cyclicals like financials, energy, domestic manufacturers, and consumer services to their U.S. stock positions. Also, think about diversifying your portfolios across credit and spread products, especially asset-backed securities, plus real assets, select hedge funds, preferreds, and emerging market debt. Thanks as always for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.